Hi there. UK property owners are anxiously asking if mortgage interest relief will rise to 22% in 2026. Well, we have the right answer.
Let me ask you a quick question. If you're a UK landlord, what if I told you that some apparent good news about a 22% tax credit is actually a warning shot for a much bigger tax bill on the horizon? Stick with me, because the way your property portfolio is taxed is about to change, fundamentally, and you really need to be ready for it.
Here's a number that should really make you sit up and listen. 2.4 million. That's the estimated number of UK landlords who are on track to face a higher tax bill by 2030. This isn't just a minor adjustment. It's a huge shift in how your income is treated, and it's coming a lot sooner than you might think.
Now, before we get into the nuts and bolts, it's really important you know where this analysis is coming from. This entire breakdown was put together by the expert tax advisors over at My Tax Accountant, one of the UK's most trusted firms. So you can be absolutely confident that what you're hearing is authoritative and bang up to date.
Right. Here's what we're going to cover. First, we'll get straight to the answer about that 22% tax credit. Then we'll unpack the new tax system that's behind it all. We'll also look at the bigger picture, see what else is coming down the track for property owners, and then talk strategy. And we'll finish up with a clear action plan so you know your next steps.
Okay, let's start with the question that probably brought you here in the first place. What is the real story behind this 22% figure that's been talked about?
So, the big question on every landlord's mind is this. Will the tax credit for mortgage interest, which has been stuck at 20% for a while now, finally go up to 22%? For anyone with a mortgage on their properties, this is obviously a massive deal.
So, the short answer is yes, the credit is rising to 22%. But, and this is a really big but, it is absolutely not the good news you think it is. This change is just a side effect of a much larger and honestly a much tougher shift in the tax world for most landlords. Stay with me, because what I'm about to explain is absolutely crucial. Okay, so here's the catch. The only reason that tax credit is going up is because the government is rolling out a completely new, totally separate, and, you guessed it, higher tax system that applies only to property income.
Just take a look at this table. It lays it all out in black and white. The top row, that's the standard income tax you're used to. But look at that bottom row. From April 2027, property income gets slapped with a 2% surcharge across every single band. So your basic rate jumps to 22%, the higher rate to 42%, and the additional rate to a really quite staggering 47%.
So here's the key takeaway. The only reason the mortgage relief is rising to 22% is to match this new higher basic rate. They have to do this, otherwise you'd effectively be paying tax on the money you're using to pay your mortgage interest. Let's be crystal clear. This is not a tax cut. It's just a mechanical adjustment inside a new system where, overall, you will almost certainly be paying more tax.
And if you're wondering why they're doing this, well, HM Treasury has been pretty blunt about it. They see a gap between the tax paid on work, which has national insurance contributions, and the tax paid on assets like property, which doesn't. This 2% surcharge is their tool to try and close that gap. It's a very deliberate move to tax assets more heavily.
Right. Let's zoom out for a moment, because this isn't happening in a vacuum. It's not just about landlords. It's all part of a much broader, coordinated strategy to raise taxes on every form of income that comes from assets. You'll definitely want to hear this part.
It's really a three-pronged attack. First, dividend tax is going up by 2% in April 2026. Then, a year later, savings tax also gets a 2% hike. But here's the clever little trap that catches so many people out: the change to the ordering rules. As it stands, you can use your tax-free personal allowance against whichever bit of your income you like. But from 2027, you have to use it against your employment or pension income first. And what does that mean? It means more of your rental income gets pushed into those new, higher tax brackets. It's a very smart way to make sure these new rates really bite.
And it doesn't stop there. On top of these direct tax hikes, there are other big pressures building up for property owners, creating what you might call a perfect financial storm.
First up is that powerful, silent tax increase we call fiscal drag. The government has frozen all personal tax thresholds right through to April 2031. So as your rental income naturally increases with inflation over the coming years, that freeze will quietly pull more and more of your profit into the higher tax bands. It's something that will seriously amplify the impact of those new 42% and 47% rates.
And then there's the new high-value council tax surcharge, or what some people are already calling a mansion tax.
From April 2028, if you own a property in England worth over £2 million, you're going to face an extra annual charge. It's £2,500 a year for properties over £2 million, and that jumps to £7,500 for those over £5 million. And the crucial bit, this is charged directly to you, the owner, not the tenant. So what on earth does all this mean for you, practically speaking? Well, it means you are now standing at a strategic crossroads. You simply cannot assume that the way you've structured your portfolio up to now is going to be the most efficient way forward. A really big decision is looming. This slide really breaks down the core choice. On one side, holding property in your personal name means you're facing those new 22, 42, and 47% rates, and you only get that 22% credit for your mortgage interest. On the other side, a limited company pays a flat corporation tax of up to 25%. And this is the critical difference. It can deduct the entire mortgage interest cost as a business expense. Of course, there's a trade-off. Getting the money out of the company through salary or dividends is also taxed. And remember, dividend tax is going up. And here's a vital piece of advice from the experts at My Tax Accountant. A lot of landlords think that incorporating is a simple fix, but it's not just a paperwork exercise. The actual process of transferring your properties into a company can trigger immediate and often very large bills for both stamp duty and capital gains tax. It is absolutely essential that you model these upfront costs before you even think about making a move. It might not be the silver bullet you're hoping for. Right, so the most important thing here is to be proactive, not reactive. Let's walk through the exact timeline so you can get these key dates firmly in your diary. This timeline shows you exactly how this squeeze is going to roll out. It all kicks off in April 2026 with that dividend tax hike. Then the big one for landlords lands in April 2027. That's when the new property tax rates and the new 22% interest credit both start. The mansion tax follows a year later in 2028. And don't forget that fiscal drag from the frozen tax thresholds is there in the background the entire time, right the way through to 2031. All of this really boils down to one final, crucial question you need to ask yourself. We've seen that the landscape is fundamentally changing. A completely new tax system for property is on its way. So the question is your portfolio currently structured to be as resilient and as tax efficient as possible for what's coming next? And just before we finish, a quick but very important disclaimer. Everything we've discussed today is for general guidance only, and it's based on the rules as we know them in February 2026. This isn't personal financial advice. Tax laws can and do change, so please don't rely solely on this to make your decisions. For advice that's actually tailored to your personal portfolio and your specific circumstances, we really do recommend you speak to a professional. The expert team at My Tax Accountant are ready to help you navigate all these complex changes. You can reach them on the details you see on your screen now. And finally, to stay ahead of future changes and get more essential updates just like this one, please do subscribe to the My Tax Accountant YouTube channel. Thank you for your time.